All right, let's kickstart the show then. Manishi Raychaudhuri, MD of Asian Equity and Strategist at BNP Paribas Securities is with us. Manishi, hi, good morning. Thanks for being with us. First up, what's your broader call on the market? Are we right now in a bull market consolidation, or would you be cautious in the market?
I'm possibly constructive compared to where I was earlier, maybe even one quarter back. But to be really aggressive on India, I think there are a few other things that also need to fall in place. The first thing out of that is that the investment climate needs to get better, and for that we need corporate confidence to come back. Second, we think fiscal balance, fiscal stability, or in plain words, reduction in the subsidies and reduction in fiscal deficit, that has to be a little more entrenched and sustainable. And as a consequence, that has to lead to this decline in sticky inflation that we are seeing right now. Now, both of these, if you look at corporate confidence and the decline in fiscal subsidies, they seem to be contingent on the political event, the general elections that we're looking at sometime next year. So India really seems to be a second half of 2014 story if the political outcomes turn out to be in the correct direction.
All right, so that's a fairly long-term call in terms of 6 to 12 months. But in the near term, really the issue is tapering or the Fed event. How do you think market will react to that? If there is some sort of tapering, do you think emerging markets will underperform?
Our point of view is that the tapering would possibly start in March with the FOMC meeting on 19th of March. The initial quantum of reduction in bond purchases would be about $15 billion, and it would be whittled down to zero by the end of 2014. Now, having said this, I think the initial beginning of tapering or the news flow building up to tapering would induce some volatility in Asian markets, just like we had seen in around May, June this year. Having said that, I think the quantum of that volatility is likely to be lower than what we have seen in the past, because number one, it's no longer a big surprise. It has been well telegraphed, well discussed across different economic forums and central banks for quite some time now. And the second reason is that the vulnerable countries, particularly India and Indonesia in the Asian context, have taken certain corrective actions and at least to some extent gotten their houses in order. In case of India, we are seeing current account deficit down to about 1.2% of GDP in the last quarter. And I don't think it will accelerate much further, so that the full year current account deficit may be around 2.6 to 2.8%.
Okay. Manishi, what about tomorrow? Do you think a 25 basis rate hike is coming, and has the market already factored that in?
I think it is, honestly. You know, if you look at the extent of stickiness of CPI inflation, it would clearly appear to be so, and the RBI has now clearly stated that it is treating CPI as the indicator of inflation. I would think 25 basis points repo rate hike is very much on the cards. The only good point is the market seems to know that. Given the extent of core inflation increase, I think that is factored in. In fact, I've heard from some quarters of the market that they're expecting another round of hike, possibly in January. But the key message here is that tight liquidity situation is likely to continue for some more time.
Okay, in that case, how would you approach rate sensitives, especially banks?
One has to be very selective in the rate sensitives, particularly banks. We do like the private sector banking space, but within that, we would rather play those which don't depend on wholesale funding, or in other words, who have a very strong liability franchise in the form of a high CASA. That really brings us to possibly a very restricted set of about 3 or 4 large private banks. Apart from that, I would continue to be cautious on the PSU banks on account of the concern on asset quality. I don't think that concern is still behind us. And secondly, I would continue to be cautious about those private sector banks which are heavily dependent on wholesale funding.
Let's talk about some stocks which have led the market, Manishi. IT to begin with, we've seen big P re-rating in Infosys from, of course, 12-13 times to what it is now. Do you think that will continue? And within IT, what would be your own pecking order?
I think in case of IT, what we have seen, that re-rating that you talked about, that re-rating has essentially been driven by the currency depreciation. This year, we have seen currency depreciate by around 15 to 20%, and give or take a few percentage points, that has been the extent of movement in most of the IT stocks. The more fundamental driver, which is an improvement in demand, and which is what we are forecasting looking at any of the lead indicators like the ISM survey or the Philly Fed survey, that impact is yet to kick in as far as the stock performance is concerned. So we continue to remain bullish on IT. We think there's clearly more steam left. Our pecking order would possibly be Infosys, HCL Tech, TCS in that order.
What about L&T? That's been the other leader. You have been bullish in the past, but from 700 to what it is now, almost 1100, is the run done on this one?
It's an interesting question because, yes, fundamentally, I have been positive on L&T and it has performed well. Now, naturally, that kind of outperformance puts every fundamental analyst in a quandary because, there's then a tug of war between fundamentals and valuations. I think, investors who don't really have L&T in their portfolio would possibly be well advised to wait for a small correction. I think this consolidation phase that we are seeing in the market, that would continue for some more time. And, if it drags down some of the relatively better stocks, that would provide an entry opportunity. But fundamentally, we continue to like L&T for two simple reasons. Number one, it has proven experience and expertise in pretty much all areas of engineering, construction, and infrastructure. Secondly, it has a relatively deleveraged balance sheet compared to the sector, and that's a very important advantage in this sector.
Manishi, what about deep cyclicals like metals then? Tata Steel, for example, has seen a big rally. Will you stay invested in the metal space?
On the metal side, we are still not bullish. And the clear reason behind that is still the fundamentals of the sector. We think there are very large overcapacities that have been built up in the base metals, be it steel or aluminium, particularly in China. The Chinese metal companies are still operating at about 65 to 70% capacity utilization. There's an unwillingness to shut down the relatively inefficient capacities because of the employment question, which is so relevant there. And as a consequence, we would see the base metal prices likely head down across 2014 and possibly well into 2015. So, in the medium to long term, we are not really bullish on the base metal sector, and in the global cyclicals in general, we have an underweight.
Okay, Manishi, before we let you go, just one last question. If you, for example, are given a blank check right now, how would you put your money?
Well, put me in a spot there, but I would think it would be a combination of the exporters, the rural consumption plays, and possibly some of the private sector banks. It's the exporters, meaning I don't just talk about IT, but even some of the merchandise exporters or foreign currency earners like Tata Motors, some of the rural plays like ITC or Mahindra and Mahindra, and maybe a select few, just the top one or two private sector banks.
All right, Manishi, thanks a lot, as usual, for your time.